Hello, my name is Ben Leibovich. This is a video tutorial for the CFFU Cash Flow Analyzer software. The intent of this tutorial is to explore the process of data entry and the various applications of the software. As part of this, I'll try to give you some perspective on how you can use the CFFU Cash Flow Analyzer to not only analyze investments, but also to help guide your strategy with respect to a particular investment. I'll show you how by changing a few of the key inputs in the software, you can begin to identify opportunities. I highly recommend that you read and listen to the content of the entire Cash Flow Freedom University prior to using the software. There's simply no time in this video to address all of the definitions and formulas to any substantial degree. All of these aspects are addressed in great detail in the text and audio files as part of Cash Flow Freedom University. Therefore, you'll have an easier time gaining perspective on all the uses of the CFFU Cash Flow Analyzer if you study the content first. This is a beta version of the CFFU Cash Flow Analyzer. I would really appreciate it if, having used this software, you could take a few moments to communicate to me your observations. How can I make the CFFU Cash Flow Analyzer better? What functions would you like to see in the final version that are not currently available? I thank you in advance, and with this, let's begin. The beta version of the CFFU Cash Flow Analyzer is available for 32-bit and 64-bit Microsoft Windows OS operating systems. You will have an opportunity to select one or the other depending on your machine. This is the opening screen. There are two message boxes here, one at the top and one lower. Every step of the data entry process will be prompted with a message. For instance, in this screen the message reads, enter purchase price and down payment in highlighted fields. Enter 0 if there's no cash down payment. Click Initiate. Notice the fields corresponding to purchase price and down payment are highlighted in yellow. In this software, the fields that require data entry of any sort are always highlighted in yellow. This is how you know you need to put something in. I specifically designed it this way to help ensure that no important piece of data gets left out. So let's say that you are considering purchasing a triplex, for example, for $140,000, and that you will make a 20% down payment, which is, of course, $28,000. You enter the numbers into the fields and click Initiate. The screen refreshes. Right here in the amount financed, it tells you that you're financing a total of $112,000, which is, of course, simply a purchase price minus the down payment. The instructions now read, indicate whether the transaction will involve one or several mortgages by checking the appropriate box. So you come up here and you check one of these options. Option 1, check for one mortgage. Option 2, check for two or more mortgages. For the sake of this example, let's say that you will do this deal with one mortgage. You'll finance the entire amount that you need to finance on one loan. So you come up here and you check the box that says, check for one mortgage. Now, before I go on, let me segue for just a second. Let's say for a minute that because you are such a savvy investor, you are going to figure out a way to finance the down payment with another loan. In this case, your deal becomes 100% financed. Even if you do have a down payment requirement as far as the deal itself is concerned, in this case, it's not an actual cash down payment to you because you're borrowing the money, which means that relative to data entry, you would need to enter 0 for the down payment, but instead of one mortgage for $112,000, you would have to be working with two mortgages, one for $112,000 and the second for $28,000, which is the amount of down payment. The CFFU Cash Flow Analyzer will allow you to build into any transaction up to 3 mortgages, and I will do an example such as that to illustrate the process in just a few minutes. But getting back to our example, once you select single mortgage option, the screen will refresh, at which point the following message will be displayed. Select either simple interest, or amortized payment structure by checking the appropriate box. Click Continue. Suppose you plan to finance your $112,000 mortgage with a 30-year amortized loan at 5% interest rate. In this case, you would select the amortized option right here. Had your mortgage been a simple interest instead of an amortized type of a loan, then you would have selected simple interest right over here to the left. As soon as you make your selection, the screen will refresh. Your selection will be highlighted right here. The message box will read Enter Interest and Amortization Term and click Continue. And of course, the entry fields corresponding to both interest and amortization will be highlighted in yellow. You fill in the information, 360 months for amortization, which is 30-year, 5% interest rate, and you hit Continue. The screen refreshes yet again, and a whole lot of fields become highlighted at this point. The message box reads the following. Enter monthly income, the sum of all revenue streams including rent, parking, laundry, etc. Enter monthly expenses, out-of-pocket repair costs, GRM, and cap rate. Click Continue. Let's start with the income, and just like the prompt tells us, let's add up all of the verified revenue streams including rents, parking, storage, laundry income, whatever else types of income there may be. And let's say the current gross income for this building is $1,500 a month, which is what you enter right here. Next, you move on to expenses, making sure that the amounts being entered are monthly costs and not annual. Let's say that there are no association fees in this example. Property taxes, $130 a month. Fire insurance, $80 a month. All of the utilities will be covered by the tenants, so they remain at zero. Landscape and snow removal, let's just throw in $60 a month. Now, the vacancy factor and the maintenance factor have defaults of 5 and 10% respectively. And these are percentages of gross income. In my neck of the woods, these are reasonable numbers, 5% for the vacancy factor and 10% for the repairs. However, you will need to do your research, and based on that, you may need to adjust these for your calculations. Notice that what you are entering here are the percentages. Those are the highlighted fields. The dollar amounts for these items will be calculated automatically in a minute. The final field in the expense column is titled Miscellaneous. Now, guys, every transaction I've ever done is different, and every transaction you will do is different. And I can pretty well guarantee that on the very first deal, you will come across some expense which is not identified by name in this software. My goal was to make sure and cover all of the essentials that absolutely are present in every deal. But since I know that there will be many others you'll come across, you can bundle them up and enter them into the miscellaneous field. Okay, that's it for the expenses. Let's move on. Next is out-of-pocket repair costs. This is the amount that you plan on spending on physical improvements within a short order in order to maximize the income potential of the building. And for this example, let's say you're not going to do anything. And so let's leave this at 0. Next, let's enter the GRM, gross rent multiplier. This is a necessary figure in order to calculate the value of this building based on a GRM approach analysis. The GRM approach is used by the appraisers for buildings that are 4 units or less, so small multiplex buildings. Anything larger than that, and they typically use a capitalization rate analysis, and that's going to come next. But the only way you can figure out what the coefficient is by doing research. You can ask an appraiser, or you can maybe ask a banker, but one way or the other, you have to figure out this coefficient. Now, I go over the methodology behind both the GRM approach and the cap rate approach, and I tell you how to come up with the coefficient on your own if you want to do the research. But again, the simplest way is simply to just ask an appraiser. Well, let's say in this example we use a factor of 78. And finally, let's put in a cap rate of 10% because assuming that we've done our analysis, that seems to be appropriate for this type of a building in this type of a location. Notice, research comes up a lot. I discuss all of this in great detail in the content of Cash Flow Freedom University. You hit continue, and here we have all of the answers highlighted in blue. First of all, the all-important monthly cash flow seems to be at $403.76. This is what's left of the $1,500 of income after the mortgage and the rest of the expenses are accounted for. But this is only a small part of the entire picture, so let's keep going. If you jump down here, you will see that the GRM analysis values this building at only $117,000 based on the current income structure. And the cap rate analysis values this building at $120,600. Furthermore, the software also tells you that if you did pay $140,000 for this building, you would achieve a cap rate of only 8.61%. This is not nearly enough because based on your own research, you found out that a cap rate of 10 is reasonable for a building such as this in this location. So right away, this is one of the uses of the software that comes through. The $140,000 that you thought the building might be worth seems about 20 grand too high based on the average rates of return in this marketplace as per your research. Why would you want to accept less than the average? Why would you be okay with 8.61% if on the average all of the other investors are receiving a 10 cap on investments such as this in this location? In fact, if you're anything like me, you probably want to earn a higher return than the average. Well, how would you find out using the software the price that you would need to pay for this building if you wanted to achieve, say, a 12 cap, for instance, which would be 2 points above the average? Well, here's how. Change this field from 10 to 12. Click Continue. And as it turns out, you would need to pay no more than $100,500 for this building if you wanted to achieve a 12 cap without changing the underlying income and expense structures, which brings me to my next point. When it comes to long-term real estate investments, long-term holds we call them, there are basically only three aspects that we as investors can change in order to arrive at a higher rate of return. One, we can pay less for the investment, which would obviously drive up the return, and we just discussed this. Two, we can increase the top-line revenue without increasing the costs, or at least by an amount greater than the cost of doing so, which would result in higher cash flow and therefore higher ROI. And finally, we can lower the expenses, which again would increase our spreads, result in higher cash flow, and therefore a higher return on investment. So we've just discussed the impact of paying less for the building, paying, say, $120,000 or possibly even $100,500 in lieu of $140,000 that we started out with in order to achieve higher returns. Let's look now at another option. Suppose that your research reveals that the apartments in this building are renting for, say, $75 a month less than what the market can support. There are any number of reasons why this could happen. Absentee owner who's unaware of the market conditions. Long-term tenants in the building and the owner just doesn't want to rock the boat. Whatever. But whatever the situation may be, the point is that you know reasonably well that you can raise rents by $225, 75 times 3, right? On top of this, let's just assume that there are 3 storage units on the property and they're currently included with the rent. In other words, they're not being charged. But they could be, and in that case, they could be rented out for, let's say, $10 a pop. Bottom line, by the time you add those 2 things together, let's say that by performing $3,000 of simple upgrades, you can raise revenue by $255 a month. What would this do? What would it do to increase revenue from $1,500 to $1,755? Well, if we go back and change the monthly income from $1,500 to $1,755 and put in $3,000 for out-of-pocket repair costs and hit continue, we can see that the valuations are now in the range of between 136 for the GRM and 146 for the cap rate valuation. And the achieved capitalization rate is now over 10%. What this means to us is that this increased revenue stream of $1,755 does in fact justify purchase price for the building of around $140,000 if, that is, we are happily satisfied with receiving a 10 cap. Here's the question. Should we be giving away our entrepreneurship? In other words, should we be paying the price for this building, which is only justifiable after the increases in revenue, which of course falls on us to do? Here's the thing. By raising the rents, we're taking a risk. Even though we think the market can support the higher rent, the joke could be on us, and we could end up with 3 vacant units. If it was easy to do, guys, the previous owner would have done it by now. He would have raised the rents. So, of course, the answer is no. We should get paid extra, if at all possible, for taking on this risk. Therefore, we should always try to purchase any building at a price which is reflective of the current financials of the building, and then we should take the risk to raise the revenue and expand upon our returns. So in this case, if we bought the building for $120,000, which at rents of $1,500 a month would constitute a 10 cap, and then we raise the revenue by $255 a month, then what will we have? Well, let's fill in the information. Purchase price, $120,000. Down payment, $24,000, since that's 20% of the purchase price of $120,000. So the down payment's gone down by $4,000. Monthly income, $1,755. Out of pocket cost, $3,000. Hit continue. And as you can see, we've managed to achieve an 11.92% capitalization rate. Okay, let's switch gears and let's talk about cash-on-cash return. This is the metric that answers the question of how quickly you are recuperating the cash that you put in. So for instance, if you put in $10,000 into an investment, and this investment generates $1,000 a year of cash back to you, then this constitutes a 10% cash-on-cash return because $1,000 is 10% of $10,000. So in the original proposal, this is where we paid $140,000 for the building for $1,500 a month of revenue. The total cash investment was $28,000. It was the down payment. And as you can see, the cash-on-cash was 17.3%. By buying the building for $120,000 and investing $3,000 into upgrades which enable us to increase the revenue from $1,500 to $1,755 a month, we're able to generate 31.4% cash-on-cash. In this example, our total cash investment is $27,000, which is essentially the same as in the first example where we had $28,000, all of which went to the down payment. But because the revenue is much improved, so is the cash flow. If you remember, in the original example, the cash flow was $403.76. But in this screen, the cash flow is $706.40 a month. That's huge, guys. And of course, the higher cash-on-cash return is indicative of this increased cash flow. You are paying yourself back at a faster pace. Okay, let's switch gears again and do another example. But this time, let's say that you were able to, in fact, finance 100% of your purchase. You finance the down payment as well as the main body of what you need to get this deal done. To reset this program, you hit the Reset button at the top right corner. A message will pop up asking you whether you want to clear the purchase price and the down payment or to leave what you currently have in those fields. And I'm going to clear everything. Let's now enter the purchase price of $120,000. This time, let's enter 0 for the down payment since we'll be financing it, so it's no longer a cash down payment. Hit Initiate. Once the screen refreshes, you'll be prompted to choose either single or multiple mortgages. Once you do that, you'll be taken to this screen. The message reads, select desired number of mortgages, up to 3, by checking the appropriate boxes in the left column. If using 2 mortgages, enter only the amount of the first and click Mortgage Select, which will automatically calculate the amount of the remaining mortgage. If using 3 mortgages, enter only the amounts of the 2 out of the 3 and click Mortgage Select. I designed the software this way to help avoid the possibility of you entering too much value into these fields. All of your mortgages combined cannot exceed the total amount financed. So what happens here is that the software subtracts the known mortgages that you entered from the total amount financed and establishes the value for the remaining mortgage which you didn't enter. And just to remind you, only the cells that require values will be highlighted. So let's say that we'll be using 3 mortgages in this transaction. Here it tells you your total amount financed. And since you didn't enter any cash down payment, the total amount financed shows up as the entire purchase price. Let's say that the first mortgage will be for $96,000, which is 80% of the purchase price. The second mortgage will be for $16,000. These are the only 2 you need to fill in. The third will be calculated automatically. Hit Mortgage Select. The new message reads, choose either simple interest or amortized payment structure for each of the mortgages. Fill in the interest rate and term in the highlighted fields. Click Calculate. Let's say the first loan will be an amortized loan at 6% over 360 months. The second loan will be at 8% over 120 months. The last loan will be, let's say, an interest-only loan at 5%. Hit Calculate. And as you can see, all of the monthly payment amounts show up in the right-hand column. The messages are, if satisfied, click Return to Main Form. If you are not satisfied with the results, you can repeat the calculation by changing the inputs and clicking Calculate. Click Clear All before changing mortgage amounts or the number of mortgages. We hit Return to Main Menu, which takes us back to this screen. The message prompts us to click Continue in order to move ahead, at which point all of the fields in which we need to enter information will be highlighted. And let's just keep all of the inputs the same as before. Income, $1,755, property taxes, $130, $80 for insurance, $60 for landscape, out-of-pocket costs of $3,000, GRM, $78, cap rate, 10, hit calculate, and here's what we get. Let's talk about these results. First of all, the monthly cash flow is down to $418.73 from over $700. And this is understandable since we financed the entire $120,000, meaning our mortgage expenses have gone up. We've lost about $280 a month because the mortgage expenses are higher. But look at cash-on-cash return. It's at 167.49%. Now, how's this possible? The cash flow is down, but the cash-on-cash is up drastically. Well, if you remember what cash-on-cash is, it is the relationship of cash invested to cash recovered represented as a percentage. Now, our monthly cash flow in this example is $418.73, which is just over $5,000 a year. But our total cash investment in this example was only $3,000. The rest of this deal was financed. All of it, 100% of it. This means that in this example, we've invested $3,000 of our cash to generate over $5,000 in the first year. This is why the cash-on-cash is so high. Another way of looking at this is to say that we gave up around $280 a month of cash flow, but in return, we were able to keep $24,000 in the bank. All it really cost us to do this deal was $3,000. I don't know about you, but I will trade $280 a month of cash flow for not having to spend $24,000 of my money anytime. Why? Because cash is king. It looks better on my balance sheet than somebody else's. Besides, the numbers clearly bear out the reality that the less your investment, the higher your investment return. But it goes even further than that. And that is the very intuitive part here. Many people simply don't have this money. For many people, 100% financing is the only way to enter the game of real estate. So not only is this how sophisticated players play this game, because it makes mathematical sense, but it is also a way to get into the game without a lot of capital. This is what makes real estate the most accessible investment vehicle, in my opinion. Well, what are some of the other things that you can do with this software? For instance, looking at this screen, you might ask yourself, how would this deal change if I had to spend more cash on the remodeling? Let's say $10,000. Change this from 3 to 10,000. Hit continue, and here you go. Or what would this building be worth if an appraiser determined that the GRM factor, which is appropriate here, is only a 72 and not a 78? Change this to 72, click continue, and here you go. Or here's another one. Here's a good one. What if we bought this building for $120,000, but instead of spending money on upgrades in order to hike the rents, we didn't spend any money and just left the rents at $1,500 a month. Change this back to $1,500 and change this to 0 and hit continue. The achieved cap rate looks like 10.05%, but the cash-on-cash return, look at this, infinity. Guess what? You invested no cash to make over $2,400 a year. That's why it says infinity. Well, this is the CFFU Cash Flow Analyzer software. I hope you would agree with me that this is indeed a useful tool. It is useful as both a means of conducting analysis of income-producing real estate, but also it is a very useful learning tool. I promise you that if you use this enough, if you play around with the numbers in the software enough, that you will begin to develop a clear understanding and a sense of how the numbers all fit together in a successful real estate deal. Thank you, and good luck with all of your endeavors.